Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody. Welcome to this Tuesday, December 5th edition of Trading Places live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. Had a little bit of mixed action yesterday. We saw the small caps doing well, some of the other areas of the market not so well, but overall still hanging in there. Market still holding on to the majority of its late October through November gains. We've seen those gains pick up on the small cap index here in the past couple of days. So seems like the party's shifting a little bit now over to the small caps. And I've got some interesting charts at the end of the show I'll show you, but there's reason for it. And we'll go over that a little bit later in the show. Do want to mention that we've got a couple of key economic reports coming out later this week. We do have the ADP employment report that will be out tomorrow. And then, of course, non-farm payrolls will hit on Friday morning. I think this is going to be interesting, mostly because it's either going to really make the path easy for the Fed, or it's going to just kind of muddy the waters. I think if we get a strong non-farm payrolls report on Friday, I think that's going to set the market up potentially, or at least maybe turn the attention back to the Fed a little bit. We've been having very mild inflation readings. I think all of that still points to lower interest rates, lower inflation continuing down the road. But that one monkey wrench that could be thrown in would be a really hot jobs report. So that's the one thing I'm looking at later this week. We'll see whether or not we get that, or if the jobs number comes in positive but below expectations, I think that would continue to be nirvana for equities. And we've been seeing what has happened recently and in this fourth quarter as inflation drops and as rates fall and growth continues. We just saw that GDP, the third quarter GDP, which we saw the second estimate come out, and it rose, I think, from 4.9% to 5.2%. Now, growth is expected to moderate considerably in 2024, but when you start raising, and revising higher, it does bring into question maybe a stronger economy than we think in 2024, and that will play into what the Fed does. So all of that, I think, is going to be kind of interesting as we go throughout the week. But otherwise, I think the market's hanging in pretty good. I will go through and let's go to start on I'm just going to pull up the dashboard today and just kind of go through it here. You can see the Dow Jones down 41 points yesterday, the S&P 500. Actually, let me see if I can get this. There we go. S&P 500 down 25, the NASDAQ down 119 yesterday, which you can see on a percentage basis down 0.84%. That was the highest loss that we saw, except for the NASDAQ 100, which is more concentrated on some of those bigger names like Apple and Microsoft. That actually took a little bit bigger hit, fell 1% on the day. Small caps and mid caps, though, you can see it. A big change over what we've been used to throughout the past year, where we've normally seen the NASDAQ, with few exceptions, the NASDAQ kind of leading, the S&P 500 following suit, and then trailing behind has been small cap S&P small cap 600 and the mid cap 400. So that has been a little bit of a reversal here in the last week or so. And it's a welcome reversal, welcome transition, rotation, whatever you want to call it. But small caps up 1.3% yesterday, mid caps up almost 0.8%. And that was in the face of mostly selling on the other major indices. So pretty good action, I would say, there in the small cap arena, along with the mid caps. If we look at sectors, if you go over to stock charts, I just like to point this out once in a while. I normally have all this information up, but I do like, for anyone maybe who's not familiar with stock charts, or maybe wants to try stock charts, it's a platform I've been using for 2 decades, and I would strongly encourage you to use it. But I know some of you use your own platform. So I just wanted to point out, under member tools, if you scroll down, first you'll start off with just some of the default there at the top. But then if you go down under charting tools, you'll see a lot of things. Seasonality, I like to use a lot. RRG, is something that I really like. I don't show it on here probably enough, but it's a great way to visualize whatever kind of rotation you're looking at. Pull up an RRG and play around with that. Great tool. But down under summary pages, this is where I normally get my information on sector summary. And when the stock market opens, this is one of the first pages I look at. I just want to see where the money is going at the beginning of the day, and then kind of get a sense of how the rotation's taking place throughout the day. So this is a great place to start. And you can see yesterday, real estate, healthcare, two defensive areas led the market. But that actually benefited small caps, because if you look down here at the bottom, technology hit hard, communication services. These are areas that would normally be associated more with the NASDAQ. Many of these companies in communication services, of course, we have internet names like Google and Netflix and some others. You got technology, of course, semiconductors. You could be thinking about NVIDIA, AMD, Intel, excuse me, some of those names, Qualcomm. And so two of those three bottom sectors being related really more toward the NASDAQ. That's why we saw that rotation. It's not a horrible thing. In fact, as we went into December, I've been telling members to expect this. This is normal in December. The third month of each calendar quarter tends to see money rotate away from high growth areas and more value oriented areas benefit. So I would use this just as, knowledge. I mean, once we saw the IWM break back up above that 181.76 level, I mean, I was talking about the IWM recently. We'll pull the chart up here in just a couple minutes, but we had gone up to 181.76 a couple weeks ago. And then I think it was just sometime last week, we hit a high of 181.75, literally 1 penny below resistance. And actually, it was on Wednesday morning. No, it was on Tuesday, I think, because when I went in on Wednesday, or maybe it was on Wednesday morning, I have to take a look. Anyway, when we had our live trading room on Wednesday, I talked about the fact that I wanted to see the IWM break out. I wanted to get through 181.76. As soon as it backed off of it, I sold my IWM. And I think it was like 181.55 was my executed price. And it wasn't because I wanted to be out of the small caps. I just don't like false breakouts or false attempts at breakouts and then watch it go down another $2 or $3 again to the downside. So after it broke or failed to break out, it pulled back and actually went down a couple of dollars. I started getting back in, and actually when it went through 181.76 was when I went into more a little bit more aggressive stuff with the TNA leverage on the IWM. So, I mean, I like small caps. I was expecting it, but I needed to see the confirmation. To me, that's always important. I mean, we can talk about what we think is going to happen, but till it happens, I think you have to at least consider the possibility that it's not going to happen. So that's the reason for, waiting for that confirmation. I mean, we only went back a couple dollars from 181, but we could have gone back to test the 20-day. I mean, we could have gone back $5 or so. And I didn't want, as a short-term trader, I had nice gains. I didn't want to turn around and give them right back. So I'd had some questions come in asking me why I, didn't like the IWM anymore. I wanted to clarify that. I really like the IWM. Right now, it's showing tremendous strength, and there's reasons for it. As I mentioned, I'll talk about those a little bit later in the show. But the fact that we've got communication services technology down near the bottom, that's hurting the NASDAQ and even the S&P 500 to some degree, because these are areas that are much more widely represented on those key indices. Discretionary kind of was in the middle. I did like the fact that industrials and financials continue to outperform the S&P 500. That has started. In the case of financials, you might be surprised at where we are on a relative chart. And again, excuse me. You'll be surprised on the XLF how far we've gotten on relative strength. But that when I looked at it this morning, I knew financial's been doing well, but when I looked at it this morning, I was kind of surprised. Again, I'll show you that in just a bit. Moving on to the 10-year Treasury yield, not a whole lot. Economic reports this morning. I think, we've got the ISM Services Index. We do have the JOLTS coming out. The expectation there is 9.4 million. This is a report that tracks the monthly change in job openings. So it's just, there are some that like to follow that. For me, it's more about the actual job reports, the ADP employment report, and especially non-farm payrolls. I think the biggest reports for me are non-farm payrolls, the inflation reports, the core or monthly CPI, PPI, especially at the core level. Retail sales, I like to follow along. I mean, those are some of the reports I think are the among the biggest in terms of the economic outlook. But anyway, 10-year Treasury yield. Remember, been talking about this measurement, the 410, ever since we broke the neckline at 455. I don't see anything changing my mind. Today, we're setting a new low. Let's get an update, see where we are now. 420, 4.203. Getting ready to go below 420. 410 is not very far right here. That would be your measurement. And the way you do these measurements is if you take the neckline. So when you're going up, a topping pattern, one topping pattern is a topping head and shoulders pattern. And so it literally, if you look at somebody, it's like a head and shoulders. You get a left shoulder, you come back down, show some weakness. You get up, you put in a higher high. You come back down, you go back down to that neckline. You have sometimes a really weak right shoulder, which in this case we did up to the 20-day moving average. And then the big red candle that breaks down below that neckline. And when I look at this, the reason that the head and shoulder patterns are so important to watch, especially on something where I was expecting rates to top. So of course I'm looking for reversing signs. Well, it usually starts on a head and shoulder with a negative divergence. So when you go from the left shoulder down and you put in the head, a lot of times what you'll see, higher prices, or in this case, higher yields, lower PPO. So that is just telling you that the momentum is slowing. Then you come down, and instead of putting in a higher low, which is what we had been doing for the last several months, we actually go down and we put in an equal and even a slightly lower low intraday. And so you kind of get this sense that, okay, we already know momentum slowing. We've already gone back to the prior low, which we had not been doing. We've been putting in higher lows. So we already got a couple of things there that are looking a little shaky. And the fact that we put in a little bit lower low tells me that this support level couldn't hold. And so now we're starting to really ram up against that key support. And when we take that final move to the upside, if we fail and come back down through, that is a bearish development on a chart. Whether you're looking at the 10-year Treasury yield, whether you're looking at Apple, whatever you're looking at, until proven otherwise, that's a breakdown. That is a reversing pattern. And then the measurement comes from basically the top, roughly 5% down to 455, which is how much? That's 45 basis points. So when you lose 455, you tack on another 45 basis points to the downside, and you go down to 410. That's how the whole calculation works. So for those maybe who hadn't been watching the show, because I've talked about this in the past, but 410 is the initial measurement. And that doesn't mean it stops there and it goes right back up. That's just your initial measurement based on the pattern. So at that point, somewhere in here, 410, I would expect maybe we'd have a fairly decent bounce, maybe back up to the 20-day. And then I think we're going to see it go lower. I don't think we're going back down to where we were 2 or 3 years ago. In fact, I'm pretty confident that we're not going to go down to that level. First of all, that level occurred because of the pandemic. And that was a one-off, once in 100 years kind of pandemic. So I don't see the same movement in the yield back down there. So if you're waiting for rates, you're looking for a house and you think mortgage rates are going to drop back down to 2.5, I wouldn't be counting on that. To me, that would be, maybe a 2% chance. I think probably the 10-year Treasury yield, which tracks the mortgage rates pretty closely, I'm thinking we're going to probably be in this 3 to 5% range for a while, maybe years. Again, things may change, but when we go back down, if we do keep going down, you're going to find some pretty good support on the yield eventually above 3%, down around that 3.30 level. And again, I don't know if we go all the way back down there, but we're heading in that direction. And so I think that our high and low this year could be kind of where rates go back and forth. And for those who think, well, when it goes up, that's going to be bad for the market, 3 to 5% interest rates historically, we're talking about really low interest rates. This is, I think this would lead to further economic gains. I think if rates stay in the 3 to 5% range, we're going to see the economy expand. And as long as inflation remains in check, there's going to be no reason for the Fed to raise anymore. So we'll start seeing the Fed cut. And then you're going to see the banks start to flip because they've been inverted. They've had that inverted yield curve. And when they flip, they start making money. I mean, the good news is that the banks, even though they've had this inverted yield curve, they have not cut down as much as you would think they would cut down in terms of lending. And so that's kept the economy fairly strong. So that's what you've got to look for. Is the selling in the banks contained? And so far it has been. So that's why we're not seeing a recession. That's why I still believe we're going to have a soft landing. But we'll see. That's going to be further down the road. All right, S&P 500. So 4,600. I mean, this doesn't take a rocket scientist here. Let's pull up that resistance. There it is. I mean, it's 4,600. And where did we get to? I think we got to what, 46.97 or 98 or 45.97, 98. So we're right up against resistance. We've pulled back. We're consolidating. Beginning of the year, I said we finished this year at 4,700. I think I'm going to be pretty close because I do think we're going to break out before the end of the year above 4,600. Do we get all the way to 4,800? Do we stop at 4,700? Do we go up and then pull back and finish, somewhere around 4,650? I don't know. But 4,700, I think, is going to turn out to be a pretty good prediction. And by the way, we got our Market Vision 2024 coming up in just a few weeks. And I'm going to talk about that in a couple minutes as well. But anyway, 4,600 right now. You've got to respect that resistance level on the S&P until it gets taken down. I believe it's going to get taken down. Do we get a 20-day test first? Well, if we struggle this week, if we can't get through it this week, I will tell you that next week is historically a very bearish month for equities. So if we can't get through 4,600 this week, chances are, I believe the odds would increase. We're going to see a 20-day test and maybe even get back to the top of this gap support, which would be around 44.60. That's a very strong possibility. Again, if we can't make the breakout and we go into next week and we just do what we normally do in that second week of December, we could see a pullback maybe to at least that 4,500 level. I mean, it's only what 1.5, 1.75% from where we are right now. All right. What else do we have? Let me come out. Let's take a look at the other indices. NASDAQ 100. NASDAQ 100 already broke above that July high. So we don't even have that to worry about. The only thing we have to worry about here is that all-time high. And if we go back to the weekly chart, we will see it's up above 16.5, somewhere around 16.7, 16.8. And we were just above 16,000. So almost the entire cyclical bear market of 2022 has been erased on the NASDAQ. And I believe by the end of the year, all of it will be erased because I do think the NASDAQ goes back probably to another high in the second half of December and maybe tests the 16.5 to 16.7 area. And I'm saying maybe because this December is not usually a great month for the growth area. So I do want to tame my enthusiasm a little bit here in December for some of those growth stocks. IWM, this is the small cap index. This is exactly where, we have been, this is exactly where the money has been running. I mean, you can see the move here from 179 to 186 just in the last 2 days. And this was that high I talked about. So if you look at and inspect this, first of all right, before we even inspect, let's annotate this. Because one thing we have to be aware of is that there was gap resistance right about there. Do you see this move up? We got up to 181.76. And we came back down, and the open and the close was beneath key resistance. Gap resistance there, gap resistance, and then price resistance. So we were up above both of them, taking off. This was after we had the big inflation report the day before, where we had just absolutely soared on the small cap index. Next day, we were making this breakout, right? We failed. So when we went back up, this would have been on Wednesday of last week. So it was on the trading day, live trading day. In the morning, we shot up higher and we got up to 181.75. 1 penny from making that breakout, and we started to turn back down. And so just as a short-term trader, and having been through the last couple of years with that cyclical bear market and with the IWM underperforming for quite a while now, I'm like, do I just assume it's going to go through? Or do I take the profit that I've got in my hand and let the market show me what it's going to do? And so I took the latter approach. I said, okay, let's get through 181.76. I'll jump right back in. If I have to give up 20, 50 cents or whatever, that's not really that big a deal. It's better than losing $5 and going back to 176 to test the 20-day moving average, which was another possibility. So that was the reason. It was just short term. But then we came right back up. I actually was buying on the way back down over the next couple of days. I had a couple of different levels that I was just getting in piecemeal. But then when it broke back up above 181.76, that's when I went into the TNA. Because first of all, if you look at seasonality, and I've got that, well, I'll talk about that in just a little bit. But November and December, and even a little bit into January, February, this is where small caps make their run historically. So I've been watching, I've been waiting, I've been hoping that we would see this move, and it's good for the market too. Even the bears out there, they're saying, breadth has been horrible. Market's been going up. It can't keep going up because not enough companies are participating. Well, now you got a pretty large group. This is the Russell 2000. This is 2,000 of the smallest companies within the Russell 3000. So you take the Russell 3000, which includes a lot of the big companies, and then you take the 2,000 smallest companies within the Russell 3000. That's what the Russell 2000 is. So if you're looking for breadth, this is a really good index to see it. So yeah, the NASDAQ maybe is struggling a little bit right now. The S&P is struggling, but guess what? Here come the small caps. Here comes your breadth. And so I'm liking what's going on. I like to see wide participation. This doesn't mean that the IWM has to lead for the next year. In fact, I don't know how long it's going to lead, but when it stops leading, I'm going to probably be right back over to the QQQ. But let it go. I mean, this is good for the market. We want to see more stocks breaking out and participating, because the more stocks that are healthy, where do the bears turn? I mean, if they keep looking for stocks that are beaten down, and a lot of those beaten down stocks are starting to turn more bullish, which is the case with many of these Russell 2000 companies, what do you do on the short side? There's less and less fertile ground here for shorting, in my opinion, as we see the IWM start to play a little catch up. So here on the IWM, I'm watching 190. I think eventually we're going to go back up and break out above 200. That's what I believe is going to happen. I don't know if it's going to be straight away now throughout the rest of this month, or if we're going to have pullbacks. But I think the two key levels you've got to watch on the IWM, 190 is your first level, and then 198, 199. If you start seeing 200 print, that's going to be a really good sign for not only small caps, but for the overall market. All right, transports. This is an area that's helping small caps. Transports and small caps tend to go, kind of move together. And the common sense reason for that, for me, is that transportation stocks, if you got truckers, railroads, they're generally going to move when our domestic economy is strengthening or expected to strengthen. That's normally when because you're going to ship more goods. Well, if you think about it, what do small caps do? Small caps don't have as much operation overseas. Most of the small caps are going to be more domestically oriented. So they're going to do well when the US economy is strong or expected to strengthen. And so I think the combination of the transports going up with the small caps is a good confirmation, powerful confirmation that maybe we're seeing this transition. And now let's see how long it lasts. All right. I do want to mention before I get into the chart of the day, I always like to bring up, especially for any of you that are new, EarningsBeats.com. If you go over, our name is plural, both EarningsBeats.com. You can go out over to our website, check us out. If you scroll down, we have a free newsletter, completely free, no credit card required. Name and an email address, hit that subscribe button. We've got literally tens of thousands on this list. So it's a very popular newsletter. We do it to give back to the community. Monday, Wednesday, Friday is when we send it out. When we do shows on here, Tuesday and Thursday, also we'll bring up a chart of the day. But Monday, Wednesday, and Friday are the ones where we actually mail out, and we'll send it directly to your email address. So just fill that information out. I like to look at things that are important to us: relative strength, price volume, candlesticks, sentiment. Talk about the overall market sometimes, the intermarket relationships. Occasionally we'll have something in there about that. It's designed to help educate. I think if you're a trader, maybe it'll provide you some ideas, but again, those ideas or the acting on those ideas is completely your risk. Obviously, I can't take that risk for anyone, but it's an educational newsletter. I think you'll enjoy it, so make sure you sign up. Now, once you've gotten to know us, if you are interested in joining us, and we have a growing community at EarningsBeats.com, check out our fall special. It is the best deal we have all year. If you click on that, you'll come down. You can do 3 different plans: 1 year, 2 year, 3 years. The further you go out, the more free months you're going to get. The best deal clearly is going out 3 years, because we're going to give you an entire year free. You pay for 3 years, you get your 4th year free, and that works out to a monthly rate of $62 a month. Our normal monthly rate is $147 a month. So you can see the savings. But if you only want to go out a year, check us out. You'll still get 2 free months. You'll get your 30-day free trial on top of that. So effectively, you'll get 15 months for the price of 12. So it's a great time to come on board over at EarningsBeats. Now, our website was down on Sunday, which it was our web host, so there was nothing we could do about it. It's completely out of our hands, but it was down a lot longer than it was supposed to be. And so we ended up coming around talking about it. And what we're going to do, if you've been to the Market Vision 2020 through 2023 events, you know how accurate those forecasts have been the last 4 years. We're going to do it again, Market Vision 2024, except this year, anyone who's not a member at EarningsBeats, there's going to be a price of $697 for attending this event. If you sign up right now, and you've got until Wednesday, which is tomorrow at midnight, if you sign up for any of these deals, you're going to get that $697 value free. You're going to come into our Market Vision event on Saturday, January 6th. So even as little as $997 is going to get you that $697 value. So already we're going to provide you some pretty awesome stuff. Yesterday, I did an event for the Bowley trend, which was a historical analysis of the S&P 500 and 16 of the most popular stocks out there: Apple, Microsoft, Tesla, Amazon, Google, Meta, Starbucks, NVIDIA, if I didn't say NVIDIA already, Qualcomm, trying to think of some of the others, AMD. Anyway, 16 of them, basically giving you how they trade on a daily basis over the last 10 years. It's already resulted in one really profitable trade that I took back at the very beginning of November, right before heading into earnings when NVIDIA went shooting up. It was that historical analysis that told me this is a great time to be in NVIDIA. Anyway, that entire spreadsheet for those who are signing up is going to be made available as well. So I don't know what that spreadsheet's worth. I can tell you I made a lot more money on my trade than $697. but this is a great time to come on board. We're trying to make it as affordable as we can, get our community up, because we want people to learn how the market works so that you can better your financial future. And you know what? If you come in and you've been with us for a year and you don't really mesh, no hard feelings, no questions asked. I get it. But I think we work with most people pretty well. And I think our members will tell you that. All right. Anyway, chart of the day today. I wanted to point out a stock that's been really strengthening. It's gone from 13 to 19 over the last month or so, 50%, obviously way better than the overall market. But I still got some reservations with this stock. And so I wanted to pull it up just to show you how I look at stocks. It may be completely different than the way you do. But when I was looking at the stock, when I first looked at price action, I was like, okay, if we get this breakout, this could be a pretty good stock to own, right? Well, and then I started looking a little deeper and I'm looking, okay, well, we've come back up in price to that mid-October high. AD line's nowhere near that mid-October high. So are we truly getting the accumulation that it would appear by price action alone? And I'm going to say no. I mean, right now it is strengthening. That's good. But we're nowhere near that prior high, even though price action is up there. So that's just a little bit of a warning sign to me. The bigger warning sign, though, is that this stock continues to be one of the worst performers in the clothing area, clothing and accessories. Look at clothing and accessories relative to the S&P 500. It has moved to probably about a 7-month high, 7-month relative high. So this industry group has been extremely strong. And yet VFC has just kind of gone along for the ride. In other words, it feels like the strong industry group is just kind of dragging, like a high tide lifts all boats, or a rising tide lifts all boats. That's kind of what this feels like. The group is going up, so it's dragging VFC along. The AD line's weaker, still haven't made the breakout. This is a stock that I just think there's so many others that would be better. Many others right in the clothing and accessories area. Why not have a leader? I mean, maybe Lululemon, for instance. I mean, that's one that you might want to be a little careful because they do report earnings later this week. But that stock looks a whole lot better. I mean, we can pull that up real quick. And it is just past 9:30. So we're going to look at the market here in 1 second. But I wanted to go over a couple more things real quick. But here's Lululemon. That AD line's not very good either, actually, as I look at it. But look at the relative strength. I mean, if the relative strength is strong and it's been outperforming its peer group for the last 10 months, I might be able to overlook this weakness. And honestly, a lot of this weakness just came right in here. And it was this one candle that created a lot of this because the volume was so hard. This is the multiplier for the AD volume. So when you get a big volume day, it is going to have a huge impact on your AD line. And if you notice, we closed at the low of the day. We were only down maybe a couple bucks. But because we closed on the low, it takes all of that volume and subtracts it from the AD. That's why you get that big hit. Outside of that, I mean, where we were prior to that, we were showing strength in the AD line. So it's really this one day that has created such a big problem. Otherwise, I think you would still see the AD line here pretty strong. So anyway, I just talked myself out of a bad AD line. I like Lululemon. We'll see what happens with earnings this week. I expect very strong numbers, though. All right, let's move on. I wanted to show you the IWM versus the QQQ because this is how you can see relative strength. IWM : QQQ. And basically what it does is the chart plots IWM divided by QQQ. So it's the relationship between the two. And you can see all year it's been going down. Now, we've had a couple of really good days here. We saw this back in June. But one thing we did in June, we couldn't get through that 50-day. Here we've done that. And we've made a move up, pulled back, and made another move up. Here, it was pretty much just a one-trick pony, just straight up and then right back down again. So I'm seeing some signs. And the other thing I wanted to show you, look at the seasonality. This is the IWM relative to the QQQ. Which month does it perform well? If you start back here at the default, which is 5 years, you can see that the IWM has outperformed the QQQ in 4 out of 5 years, right? Outside of, well, along with September, it's been the best month over the last 5 years for the IWM to outperform. And the average outperformance is much higher than September and slightly higher than February. So I would argue December's been the best for small caps the last 5 years. But what if we just keep dragging this back 1 year at a time? Kind of watch this bar right here. It kind of goes down, but if you go back 20 years, I mean, we're talking about the month where the IWM has outperformed the QQQ the most. That's 65%. Now, I haven't even done this, but I'm going to drag it back. Actually, this goes from 2004 to 2023. So if I go all the way back, I just got to go to 2003 over here. And you can see from 2000 to 2003, 75%, outperforming by an average of 6.9%. So this only goes 20 years, but if we added those 4 years to it, this was clearly the best month. And look at the average outperformance. November 0.6, December 1.3. Then we've got June over here, 0.8, which is, by the way, another third month third month of a calendar quarter. And February, those four, February, June, November, and December, over the last 20 months, those are the 4 months that have a positive relative performance, IWM versus QQQ. So if you look, November through February, January and February kind of offset one another. November and December are strong. November through February, this is kind of where the IWM has its magic. So am I surprised that the last 2 days, the IWM finally has broken out and taken off on a relative basis? No. And history is telling me that there's a good chance it continues. So that's the way I use history. I don't look at this and say I'm buying the IWM because of history. Instead, I start to look at the IWM making positive moves, holding the rising 20-day moving average, continuing to make breakouts, and then put on top of that, the fact that this is the time of the year when this normally happens. That's a good combination. Last thing, and then we'll be done. XLF, I promised you I was going to talk to you a little bit about the financials. Here you can see we're almost all the way up to February's high on the XLF. You can look at the AD line, which is strengthening, getting back close to the 52-week high. And if you look at relative strength, look at the XLF. The last 5-6 weeks, we've been going up. This is the time of the year. We talked about it back at the beginning of October. Financials and industrials love the fourth quarter, and we are seeing it now. We didn't exactly get it in October, kind of went sideways, picked up a little bit in November, especially toward the end of November, and now that's carrying over into December. So if you look, this is the highest relative level that the XLF has been versus the S&P 500 since back in late April. So yeah, the XLF is doing good things. And if we look at the XLI, maybe not quite as good, but still pretty good, moving up, getting close to the late July, early August high. And here you can see the relative strength now is moving to its highest level since back end of August, early September. So we are beginning to see that fourth quarter leadership again from the XLF and from the XLI. So history is important to pay attention to. We're always looking at it. We're always keeping our members, aware of what they can expect from history. And then when we start seeing the actual numbers, the actual price action fall into place to follow history, it becomes a no-brainer in how you want to invest. Anyway, that's it. Let's get a quick look, though, at the market. You can see that we got the Dow down about 0.5%, S&P down 1/3 of 1%, NASDAQ showing a little bit of relative strength today, which means small caps, mid caps taking a back seat. It is early, though. We'll see how things rotate throughout the day. Volatility, though, has jumped. Yesterday it jumped probably about 40 points, I think. Today up another 20, 25. So it is still low. 13's very low. I look at below 13 as being kind of like the lowest zone. 13 to 17, still pretty bullish for equities. 17 to 20 starts getting a little dicey. Above 20, you want to be careful. We're still at 13, so we're still in a really good area for the VIX, but just kind of keep all that in mind. All right, that is it for me. I appreciate everybody tuning in. I'll be back tomorrow for your next Trading Places Live. And then, of course, tomorrow at 10 a.m., I have the live trading room for members. We had a lot of good trades from last Wednesday. I'll talk about those tomorrow, and then we'll see if we can find some more for maybe this next week. Probably going to be looking at a lot more of the small caps, mid caps, based on how the market's been unfolding. And again, if you sign up using our fall special, be sure to go over to EarningsBeats.com and sign up for our fall special. You'll be able to come into our live trading room tomorrow, no charge as well. So anyhow, great special. It is going to expire tomorrow at midnight, though, so please check that out. Have a great day, everybody. Be back tomorrow. Happy trading.